One of the most frequently asked questions is that which are the best ETFs to invest in for long term, which has the potential to give higher returns and we can see our money growing over the period of time. One more common question is that where to invest. Are index fund better to invest or ETFs are better in terms of returns, and which has higher expense ratio? All these points we are going to discuss in today's video. Also, we will discuss about which are the top 5 best ETFs which can be considered for further study and research purpose. But before diving into ETFs, you must be knowing the basic difference between an ETF and a mutual fund. Especially you must be clearly knowing the difference between an index fund and an ETF, because there are many similarities in these two, due to which investors often get confused. Now look, both ETF and index fund are passive funds. They don't have any active fund manager who is trying to beat the market. Therefore, it should be very clear that they are not going to outperform the market, as they both track a specific index. But in this, if we remove or minimize factors like expense ratio, tracking error, these funds will also not underperform the market either. Now the real difference comes in, if you want to invest in an index fund, you can buy it through a mutual fund distributor, or you can also buy it through a registered investment advisor. You have an option to buy an index fund both online and offline. You have an option to directly invest in index fund through AMC website. It is not important to have a demat account if you want to invest in an index fund. On the other side, talking about ETF, as the name suggests, exchange traded fund. So if you want to invest in them, you can only buy an ETF through stock exchange, just like you buy shares of any listed company, and it is essential to have a demat account if you want to buy any ETF. And now if you want to open your new demat account, link is in the description box. Do check it out. If you want to purchase an ETF, you can buy it through any stockbroker. Just like stocks, ETFs are also listed on a stock exchange, and they provide you a fixed basket of stocks whose price is determined based on demand and supply. While investing in an ETF, you must take care of these 3 points. Expense ratio of that ETF should be lower, AMU size should be decent, and liquidity should be high, so that you don't have any problem of buying and selling that ETF in long term. Apart from this, you must be knowing about holdings of that ETF, so that you may clearly get understanding about where your money is going to be invested, and always try to buy an ETF near to its NAV if you want that your returns and fund returns match in the long term. So coming to today's list of ETFs, firstly I have selected Motilal Oswal's NASDAQ 100 ETF, which was started in 2011, and Sunil Sawant is the fund manager for this ETF. Basically, this ETF tracks NASDAQ 100 ETF and provides you an opportunity to invest in US market. Also here, if you invest, you will get a benefit of USD to INR appreciation over time. Coming to fund details, AUM size is over 8,000 crores, which is quite good. It holds 101 stocks and the expense ratio is of 0.58. Talking about the past performance, in last 1 year, this fund has given 15.9% returns. Over past 3 years, the returns are around 19.9%, and over 5 years, it has delivered 20% CAGR. There are other similar ETFs available in market which give you opportunity to invest in US stocks, but as compared to its peers, I found that NASDAQ 100 ETF is a better choice because its performance is stronger, AMU size is higher than its peers, and expense ratio is also reasonable. Overall, if you are looking to diversify your investment portfolio, investing in such ETFs is worth considering. Even mutual funds are a good option to invest in for long term. If you want to go for safer investments without taking much risk, then considering index fund can be a better choice. If you want to directly invest in stocks, because from there you can get higher returns, but there is high risk in such investments, you should be aware about this too. So directly investing in stocks of any listed company is another investment option for value investors. But here you must be knowing how to analyze companies' fundamentals and financials before investing directly. Now let's get back to the topic, and the next ETF in today's list is Nippon India's CPSC ETF that was launched in 2014. AUM size for this ETF is of 37,632 crores. It invests in top 11 PSU companies. The expense ratio is extremely low at just 0.07, which is excellent. Now if we look at past performance, the ETF has delivered very good performance, especially before the recent market correction. PSU companies performed exceptionally well over the past 1.5 to 2 years. That is why CPSC ETF has given 35.2% return over past 3 years and a massive 38.1% return over the last 5 years. However, due to this recent market decline, its performance has dipped and it has given no returns over the last 1 year. You can review the holdings of this ETF. Complete list is available and you can analyze it on your own. So Nippon India's CPSC ETF is a good option for SIP because it will provide diversification to your overall investment portfolio. After all, if you try to invest in individual stocks, it is not practical to buy all the shares of top PSU companies at once, because in our equity portfolio we usually pick limited number of stocks. Moving on to the third in today's list is ICICI Prudential Gold ETF, which has delivered impressive 30.6% returns in the last 1 year. The 3-year performance is also very strong with returns of around 20.6%, and over past 5 years this ETF has given 13.9% returns. The fund's AUM, that is asset under management, is of 7,189 crores and its expense ratio is of 0.5%. It was launched back in 2010 and since then it has shown excellent performance. If we compare this with other similar gold ETFs, the AUM size is better, liquidity is strong, and the expense ratio is lower than many other in the market. For example, UTI's gold ETF has similar expense ratio, but its AUM is smaller, which may lead to liquidity issues in the long term, because when a fund has higher AUM and trading volume, the liquidity is also better. That is why I find ICICI Prudential Gold ETF a better choice as compared to other gold ETFs available in market. However, I encourage you to do your own research and you can also share your opinion in the comment section. Moving ahead, on number 4 in this list is Nippon India's S&P BSE Sensex ETF. The AUM for this fund is of 15,948 crores. Number of stocks that ETF invest in are 30. The expense ratio is just of 0.04%, which is very low and is a plus point. This ETF was launched in 2014 and the fund manager is Himanshu Mange. Looking at fund's performance in the last 1 year, it has delivered 9.1% returns. Over past 3 years, the returns are of 13.6%, and over 5 years, it has given 20.3% returns. One of the key benefits of considering this ETF is that it brings stability to your portfolio, because here your money gets invested in top 30 large cap companies which experience less correction as compared to small cap and mid cap section in case of crash situation. Another major advantage is low expense ratio, because fewer the securities a fund invests in, its expense ratio and tracking error is also minimum, which ideally helps you in boosting your profits. Till now we have talked about 4 different ETFs which are worth considering for further research and study, and you will notice that these will provide proper balance and diversification to your overall investment portfolio. Apart from this, you can also consider options like Nifty Bees ETF, Nifty Next 50 ETF, mid cap ETF, small cap ETF, and you can build your own case studies based upon your investment goals, and doing your own research and analysis you can make informed investment decisions. But for today's list, the 5th ETF that I have chosen is Grow's EV and New Age Automotive ETF. The reason behind this is that personally I believe that companies that are working on future technologies, especially in EV space, have great opportunity and potential to show good growth in the near future. If you do your own research, you will find that there are number of companies that are working in EV space, and it is not practically possible to invest in all those companies individually in your equity portfolio. So why not consider a stock basket that already includes top companies that are working in this space? That is why I found Grow EV and New Age Automotive ETF a good option for further study and research purpose. Now you can look at the fund details. It invests in 35 companies and has an expense ratio of 0.47%, which is also reasonable. However, the AUM is still low because it hasn't even completed a year since its launch. This ETF was launched in 2024, so there is no past record for its performance data yet to analyze. But you can study its holdings, see which companies it includes, and research them individually for better insights. You can analyze the individual companies as well. Look into companies' fundamentals and financials and what other factors you find important to make informed investment decision. However, I would like to tell that there is no buy or sell recommendation in today's video. This entire discussion was only conducted for education purpose. You make your investment decision based on your own research and analysis. If you find today's video helpful, informative, I kindly request you to like and share the video as much as possible, and don't forget to subscribe to my channel Diversify Investment, and do hit the bell icon while subscribing. We will come up with another video very soon. Until then, take care. Thank you for watching.